So you want to buy a luxury hotel. Money isn't a problem for you. You've got the capital, you've got the credit, you've got a banker who returns your calls on Sundays. So let's skip the part where we pretend this is out of reach and get to the part that actually matters. Because here's the strange part nobody tells you before you sign. The better the hotel looks on paper, the more likely it is to be losing money the day you take the keys. The math can pencil out to a guaranteed profit and the operation can still go broke in 18 months. By the end of this, you'll know exactly what tier of hotel your money actually buys. How these deals get done in the real world, the hidden bill that shows up the moment you close, the twist about how 5-star hotels actually make their money, why the person who built the hotel next to yours might be your biggest threat instead of the recession, and with real numbers what you'd walk away with if you did this today. Let's start with the menu. At the very bottom of what you could even call a luxury hotel, you're looking at a boutique property, something in the 20 to 60 room range, independently flagged or running under a soft brand, in a secondary market. These trade for roughly $5 to $10 million all in, and per key that works out to somewhere around $300,000 to $500,000 a room. That's your entry ticket. It gets you a hotel, but it doesn't get you a name anyone recognizes at a dinner party. Sounds cheap, but here's the catch on that entry tier. A boutique hotel at that size almost never carries a major brand, which means no built-in reservation pipeline, no loyalty program guests showing up automatically, and no franchise standards forcing discipline on the operations. You're not just buying a building at $5 million. You're buying the job of being your own marketing department, forever. Step up and you're in what the industry actually calls upscale and luxury, a bracket that officially runs anywhere from $30 million to $300 million or more, depending on room count, market, and brand. This is where per-room valuations really start to separate from every other category of real estate. An economy hotel might value out around $50,000 a room. A true luxury flag can value out at $1 million a room or higher, 20 times the economy number, for a building that, physically, isn't 20 times more expensive to construct. That gap is the entire luxury hotel business model in one sentence, and we'll come back to it. Then there's the trophy tier, the assets that make trade publications write headlines instead of transaction summaries. Earlier this year, the JW Marriott Marco Island Beach Resort in Florida changed hands for $835 million. Around the same time, Host Hotels sold 2 Four Seasons properties, the Four Seasons Resort Orlando at Walt Disney World, and the Four Seasons Resort and Residences in Jackson Hole, Wyoming, in a combined deal worth $1.1 billion. On the smaller end of trophy, the Hyatt Regency San Francisco traded to Blackstone Real Estate for $279 million this June, which works out to roughly $340,000 per key. Modest by trophy standards, but the deal is instructive for a different reason we'll get to in the verdict. Notice something about that per-key math already. $340,000 a room for a well-located downtown Hyatt against roughly $1.9 million a room implied by the JW Marriott Marco Island number. Same country, same general asset class on paper, hotel with a well-known flag, and a 5.5 times difference in what the market will pay per room. That gap isn't about thread count either. It's about location scarcity, resort demand versus urban office travel demand, and how each property performs against its specific comp set. 3 factors we're about to walk through one at a time. Somewhere between the true luxury bracket and the trophy tier sits a category worth calling out on its own, because it's where a lot of sophisticated buyers actually want to be. The branded resort, with a name recognizable enough to command a rate premium, but not so singular that you're bidding against sovereign wealth funds for it. GenCom's acquisition of the Ritz-Carlton New York Central Park Hotel in Midtown Manhattan this year is a good example of that middle trophy category. A globally recognized flag, an irreplaceable location, but a single asset rather than a resort and residences complex, which keeps the buyer pool to serious institutional and ultra-high net worth capital rather than only the 2 or 3 sovereign funds capable of writing $1 billion check without blinking. And here's a number worth holding on to before we move on, because it explains why the price ladder is so steep. Industry-wide average daily rate for luxury hotels runs $250 to $500 a night and up, against an industry-wide average across all chain scales of roughly $100. That's not a 2 times premium for nicer sheets, it's a 4 to 5 times premium, on the same physical square footage, in many cases in the same city. The building isn't what's expensive. The exclusivity is. So that's your menu. $5 million at the bottom, $300 million in the middle of true luxury, north of $800 million at the top. Somewhere on that ladder is a number you could actually write a check for. Now the real question, how do you actually get one of these things? There are 3 doors in. Door 1 is new construction. You buy land, you hire a luxury operator or license a luxury brand, and you build from the ground up. This is the slowest and most capital-intensive path. Luxury construction costs routinely run $600,000 to over $1 million a key before you've sold a single room night, And that's before land, before entitlements, before the 18 to 36-month build timeline, where you're paying interest on a loan with zero revenue coming in. Almost nobody outside of sovereign wealth funds and the largest hospitality REITs builds new luxury from scratch. It's the least common way in and the most expensive. Door 2 is the resale market, and this is where the real action is. Publicly traded hotel REITs, Host Hotels, Sunstone, Braemar, Park Hotels are constantly buying and selling stabilized, already operating luxury assets, and their disclosures give you a live look at real pricing. That Hyatt Regency San Francisco sale to Blackstone this June was priced at a 21.4 times multiple on hotel EBITDA and a 3.5% capitalization rate on trailing 12-month net operating income. Numbers that tell you institutional buyers were willing to pay a steep premium for stabilized, well-located cash flow, even in a downtown market that's still recovering. Around the same period, Host Hotels closed its 2 Four Seasons sale at an 11% unlevered internal rate of return for the seller, meaning the buyer on the other side of that trade was underwriting a lower forward return in exchange for trophy asset stability. Read those two numbers side by side and you learn something most buyers never bother to check. The multiple a seller books and the return a buyer expects aren't the same conversation. A 21 times EBITDA multiple sounds aggressive until you remember it was paid for one specific downtown asset with a specific supply constraint. An 11% IRR sounds attractive until you remember it's unlevered, meaning it doesn't yet account for whatever financing terms you personally can secure, which could push your actual levered return well above or well below that number, depending entirely on your debt structure. This is also where you'd go looking for a portfolio deal instead of a single asset, if scale interests you more than trophy bragging rights. Late last year, one hospitality company sold the remaining 14 hotels in its Playa portfolio to Tortuga Resorts for approximately $2 billion, alongside long-term management agreements on 13 of those properties. A structure that let the seller convert an operationally complex, geographically scattered portfolio into cash while the buyer inherited both the real estate and an existing proven management relationship on day one. Portfolio deals like that are how the biggest checks in this business actually get written. Nobody buying 14 hotels at once is doing it one broker call at a time. And it's not just Blackstone and Host trading assets back and forth privately. The broader capital markets are wide open on this right now. Global hotel investment volumes are projected to keep climbing through the rest of 2026. And according to commentary from JLL, luxury is specifically flagged as the winning asset class institutional money wants exposure to. Panelists at NYU's annual International Hospitality Investment Forum this year agreed that deal activity is on track for continued growth, building on a rebound that started late last year. Translation: you are not early to this trade, and you're not the only one at the table with a checkbook out. That matters, because scarcity plus institutional demand is exactly what pushes cap rates down and prices up on the assets everyone wants, which is good news if you're selling, and a warning label if you're the one buying at the top of that demand curve. Door 3 is the distressed path, and this is where you find the deals that look like a steal until you understand why they're for sale. Braemar Hotels and Resorts announced last August that it was liquidating its entire Fort Hotel portfolio. Its own leadership said, in writing, that a luxury RevPAR lodging REIT could no longer flourish under the earnings multiples the public market was assigning it, on top of sustained pressure from activist investors. Since then, Braemar has been selling pieces off one by one. The Park Hyatt Beaver Creek for $176 million, the Marriott Seattle Waterfront for $145 million, and as of this June, 3 more luxury properties bundled for $437.5 million. On paper, forced sellers mean buyer leverage. You can often negotiate 10 to 20% off a comparable arm's-length deal. But forced sellers are forced for a reason, and that reason is usually sitting in the maintenance logs, not the marketing deck. Buy from a company that's liquidating because the economics stopped working, and you inherit the same economics. So, new build if you have 3 years and unlimited patience, resale if you want a known quantity at institutional pricing, distressed if you want a discount, and you're willing to underwrite exactly why the seller wanted out. Most first-time luxury hotel buyers land somewhere between doors 2 and 3. And whichever door you pick, the moment you close, a bill you never budgeted for lands on your desk. That bill has a name, and if nobody's told you about it yet, they've done you a disservice. The Property Improvement Plan. Every major hotel brand, Marriott, Hilton, Hyatt, IHG, requires a PIP at change of ownership, no exceptions. The brand sends inspectors through the property, and they generate a document listing every single thing that doesn't meet current brand standards. Mattresses, HVAC, lobby finishes, elevator cladding, bathroom fixtures, sometimes structural work, with a mandated timeline, typically 12 to 24 months, to fix all of it. For a major flag, that PIP routinely runs $15,000 to $40,000 per key. On a 200-room luxury hotel, that's a bill of $3 to $8 million, due almost immediately after you've already spent everything closing the deal. Industry analysts call it the single most undermodeled risk in hotel acquisitions, and they're not exaggerating. A hotel that looked like a clean 9% cap rate on the offering memorandum can effectively become a 6% deal once the PIP hits your capital account. Buyers who get their PIP estimate from the seller, or worse, from the broker, are the ones who get surprised. The only estimate that means anything is the one you request directly from the franchise before you sign. Then, once the renovation dust settles, the ongoing bill starts. Franchise fees run several percent of room revenue, off the top forever, for the right to use the brand name and its reservation system. Layer on top of that the online travel agency commissions. A meaningful share of your bookings will still route through third-party channels even with a brand's own app and loyalty program working in your favor. And each of those bookings hands away a commission before you've swept a single sheet. Property taxes on a trophy luxury asset can run into the millions annually, reassessed upward the moment the county sees your sale price on record. Insurance on a large luxury property, especially anything coastal or hurricane exposed, has climbed steeply in the last few years, to the point where some owners report premiums doubling in a single renewal cycle. Utilities on a full-service luxury property, climate control across hundreds of rooms, a full commercial kitchen running around the clock, a pool, a spa, laundry facilities processing thousands of linens a day, routinely run into 7 figures annually on a large property. A line item that barely registers on a limited service budget and dominates a luxury one. And then there's staffing, which for true luxury is not optional. A 5-star property runs somewhere close to 2 full-time employees per occupied room when you count housekeeping, food and beverage, concierge, engineering, and management, a ratio that dwarfs limited service hotels running on a skeleton crew. That ratio exists because the entire luxury proposition is built on labor. The difference between a $200 room and a $2,000 suite isn't the thread count. It's the number of humans standing by to anticipate what the guest in that suite wants before they ask. Add it up: franchise fees, OTA commissions, taxes, insurance, utilities, a payroll that never sleeps, and capital reserves for the next PIP cycle in 7 to 10 years. And you're often looking at operating costs that eat 60 to 70% of every dollar of revenue before a cent reaches you. There's also a slower moving cost that rarely shows up in a first-year budget, but always shows up eventually: technology and systems. Property management software, point-of-sale systems across every restaurant and bar, keycard and access control infrastructure, guest-facing Wi-Fi and in-room entertainment. All of it needs periodic replacement on a cycle measured in years, not decades. And brands increasingly mandate specific vendors as part of their standards, which means you don't get to shop for the cheapest option even if you wanted to. None of this shows up as one dramatic number the way the PIP does. It shows up as a slow, permanent tax on every year you own the building. The lobby chandelier isn't the expensive part of owning a luxury hotel. Staying compliant with the brand standards that make the chandelier meaningful, that's the expensive part. Which brings us to the actual reframe, the thing that changes how you should think about this entire business. A luxury hotel isn't a hospitality company. It's a real estate yield instrument that happens to require 400 employees to generate its coupon payment. Strip away the marble and the turndown service, and what you're actually holding is a piece of institutional-grade real estate priced the way bonds are priced, off a capitalization rate, off a multiple of trailing cash flow, except instead of clipping a coupon twice a year, you're funding a live 24-hour operating business just to keep that yield flowing. That's why cap rates on premium urban luxury hotels run a tight 4 to 7%, barely different from what you'd expect on a Class A office tower. The market is pricing the real estate, not the pillow menu. But here's the part that actually explains where the profit hides. Rooms are the smallest lever, not the biggest one. A true luxury property makes serious money on revenue streams most guests never think about as the hotel's business. Food and beverage, restaurants, room service, minibar markups is a major profit center precisely because captive guests won't leave the building to save $8 on a burger. It's also, sounds good, but here's the catch, one of the hardest departments to run profitably at scale, because it carries some of the highest labor and spoilage costs in the entire operation. A beautiful restaurant with mediocre covers can actually drag down a hotel's overall margin instead of lifting, which is why some luxury operators have quietly started leasing out their signature restaurant space to celebrity chef groups instead of running it in-house, trading a smaller guaranteed rent check for none of the kitchen headache. Banquets and events, weddings, corporate conferences, galas often carry higher margins than room revenue itself because you're selling the same square footage twice, once during the day for a conference and again at night as a ballroom, without having to build a single additional square foot to do it. Ancillary fees, resort fees, parking, spa treatments, that urban destination fee nobody remembers agreeing to are close to pure margin because the marginal cost of letting a guest use the gym is close to zero. Put those three together and you get the real thesis of a luxury hotel. Rooms sell the fantasy that gets a guest in the door, and everything else in the building is engineered to separate them from another $200 or $300 a day once they're inside it. Industry data on average daily rate versus RevPAR, revenue per available room, makes this visible in hard numbers. Luxury properties run average daily rates of $250 to $500 or more a night, but the properties that actually outperform their peer set aren't necessarily the ones with the highest posted rate. They're the ones running strongest against their comp set, the specific basket of competitor hotels the industry benchmarks against through STR data. A hotel running at 90% of its comp set's rate, but with better ancillary capture, can out-earn a hotel technically charging more for the room itself. Owning a luxury hotel, in other words, isn't a real estate bet, and it isn't a hospitality bet. It's a bet on how well an operator can extract revenue from a guest who has already committed to staying. There's one more variable buried in that real estate framing that most buyers don't think to check until it's too late. Whether you actually own the land underneath the building. A meaningful share of luxury hotels, especially in dense urban cores and resort destinations, sit on ground leases rather than fee-simple land ownership. You own the building in the operating business, but a separate landowner owns the dirt, and you pay them rent on a multi-decade lease. Sounds like a minor technicality, but it isn't. Hotels sitting on ground leases with less than 30 years remaining trade at a structural discount to otherwise identical properties, because every lender and every future buyer has to underwrite what happens when that lease runs out. Owning the land outright, by contrast, typically adds 20 to 40% to a property's total value because it removes that ticking clock entirely. Two hotels can look identical on a site visit, same brand, same room count, same RevPAR, and be worth dramatically different amounts because of a lease document neither guest nor casual observer will ever see. Put the labor-intensive coupon and the land question together and you get the real thesis of this entire asset class. A luxury hotel is what happens when you take a bond-like real estate yield and staple a 24-hour 4-star service business on top of it, then hope the service business generates enough margin, quarter after quarter, to justify the price the market paid for the yield. Now let's put a human face on both sides of that bet, because the spreadsheet only tells you half the story. Start with the version that works. The industry is full of operators, general managers turned owners, who didn't start with capital, they started behind a front desk. The typical version of the story looks like this. Someone takes an entry-level front desk or food and beverage job at a major flag straight out of school, works nights, learns every operational department from the ground up over a decade or more, gets promoted into assistant general manager and eventually general manager roles at increasingly larger properties, and along the way builds relationships with the lenders, brands, and management companies that eventually let them buy a small stake, sometimes just a management contract, sometimes a minority equity position in a property they used to run for someone else. 25 years later, that person owns outright or owns a meaningful piece of a hotel worth tens of millions of dollars, and they got there without ever writing the first big check themselves. It's slow, it's unglamorous, and it's one of the only real paths into this asset class that doesn't start with inherited capital. The rule underneath that story: in hospitality, operating expertise is itself a form of currency, and lenders and brands will extend financing to people who've proven they can run the building, even when their personal balance sheet is thin. What makes that path work mechanically is that a brand and a lender aren't actually betting on the person's net worth. They're betting on the person's track record of protecting a flag's guest satisfaction scores and hitting budget during a downturn, because that's the exact skill set that determines whether a hotel survives a bad cycle. A career general manager who steered a 200-room property through a recession without a PIP violation or a brand standards write-up is, from a lender's chair, a lower risk bet than a first-time buyer with twice the capital and none of the operating scar tissue. That's the quiet arbitrage sitting underneath every one of these success stories. The industry prices operating competence as collateral, even though it doesn't show up on a personal financial statement. It's also worth being honest about how long that runway actually is, because the story tends to get compressed in the retelling. 25 years behind a front desk, through night audits and overbooked holiday weekends, and at least one recession along the way, is not a shortcut, it's the toll. The people who make it to ownership this way aren't the ones who found a hack around the capital requirement. They're the ones who let the industry itself function as the capital requirement paid in time instead of dollars. Now the other side. Luxury hospitality has no shortage of collapse stories, and they follow a recognizable shape. Over-leverage a trophy asset during a boom. Assume occupancy and rate will keep climbing indefinitely. Get hit by something nobody modeled, a recession, a pandemic, a sudden shift in travel demand, and watch debt service consume cash flow that no longer exists. REIT liquidations like Braemar's aren't collapse in the dramatic headline sense, but they're the quiet version of the same failure. A portfolio built during a low rate, High valuation era that simply stopped generating a return the public market would pay for, forcing the company to sell off assets one at a time, sometimes at a discount, just to survive as a smaller entity. The dramatic version shows up in bankruptcy filings and foreclosure notices, highly leveraged luxury properties, some of them internationally recognized names, that ended up in receivership because the ownership group financed the acquisition with debt sized for boom-era assumptions and had no cushion when a downturn hit. The rule underneath that story is the mirror image of the first one. Leverage doesn't create risk in a luxury hotel, it just concentrates the risk you already had. A hotel that's marginally profitable at 70% occupancy can become catastrophically unprofitable at 55% occupancy if the debt service was sized. Assuming 70% would hold forever. Nobody who's lost a luxury hotel to foreclosure got surprised by a bad location. They got surprised by a bad year they hadn't modeled for. There's a second, quieter version of the disaster story worth knowing, because it doesn't involve a recession at all. It's the operational catastrophe, a major fire, a Legionella outbreak in the water system, a structural failure in an older building that forces a wing closed for months, a lawsuit over a life safety incident that a franchise brand's insurers refuse to fully cover. Any one of these can take a fully profitable, well-financed luxury property and turn it cash negative overnight because the fixed costs, the debt service, the payroll, the property tax bill, don't pause just because half your rooms are unsellable. Owners who've been through it describe the same pattern. The building survives, the balance sheet doesn't. The rule is the same one insurance underwriters have known for a century. In a business this labor-intensive and this physically complex, the tail risk isn't the market, it's the building itself. So let's pull it together and answer the actual question. How much would you make? Scenario 1, the optimistic case. You buy a stabilized, well-located upscale luxury hotel, a couple hundred rooms, a major brand flag, similar in size to something like the Hyatt Regency San Francisco deal, for $280 million, priced at roughly a 21 times EBITDA multiple, putting annual hotel EBITDA at around $13 million. You put down 30% in equity, roughly $84 million, and finance the rest. Best case, the market strengthens the way JLL and other industry analysts have been forecasting for the luxury segment specifically. RevPAR climbs, your comp set performance improves, and by year 3 your EBITDA has grown to around $16 million a year. After debt service on the financed balance, and after routing the mandated capital reserve back into the property for the next improvement cycle, you're netting somewhere in the neighborhood of $5 to $6 million a year in free cash flow to equity. Call it a 6 to 7% cash-on-cash return, on top of whatever the underlying real estate has appreciated. If you sell in year 5 or 6 at a slightly compressed cap rate because trophy luxury assets have gotten scarcer and more competitively bid, which is exactly the dynamic JLL and multiple hotel executives have pointed to in 2026 commentary, you could be looking at a low double-digit, unlevered internal rate of return across the whole hold period, in the same range as the 11% IRR Host Hotels achieved on its own Four Seasons disposition. Walk the actual line items. Total revenue across rooms, food and beverage, banquets, and ancillary fees lands around $40 million a year at stabilization. Operating costs, staffing, franchise fees, OTA commissions, taxes, insurance, utilities, and reserves take roughly 60% of that, leaving your $16 million of EBITDA. Debt service on the finance portion of the deal at a reasonable luxury hotel loan rate consumes somewhere around $10 to $11 million a year, which is what actually gets you down to that $5 to $6 million free cash flow number. Payback on your initial equity, in this scenario, lands somewhere around 12 to 14 years from cash flow alone, faster if you count the appreciation captured at sale. Scenario 2, the realistic to pessimistic case. Same hotel, same purchase price, but you underestimated the PIP. The brand comes back with a renovation requirement at the higher end of the range, $25,000 to $30,000 a key instead of $15,000, which on a 250-room property is an unbudgeted $6 to $7 million due within the first 18 months, funded either out of a reserve you didn't build big enough or out of new debt at a worse rate than your acquisition financing. A soft travel year, a recession, a spike in airfares, a shift in corporate travel budgets. Take your pick, knocks occupancy down 4 or 5 points, and RevPAR growth flattens instead of climbing. Your EBITDA, instead of growing to $16 million, sits flat or drifts down slightly to $12 million, while your debt service stays fixed regardless of how the top line performs, because loans don't care about your comp set index. Free cash flow to equity in this version shrinks to somewhere between $1 and $2 million a year, a cash-on-cash return closer to 1.5% to 2%, which is meaningfully worse than what you'd have earned, leaving that $84 million in an index fund, and never thinking about a property improvement plan again. If you're forced to sell in a softer window, the way Braemar has been forced to sell throughout this year, you may take a cap rate that's compressed against you instead of in your favor, and your total return across the hold period could land close to break-even once you account for the capital you sank into the PIP and the reserve fund. Walk the same line items in this version. Revenue softens to around 36 million instead of 40. Operating costs stay stubbornly close to the same dollar figure they were before. Payroll doesn't shrink just because occupancy dips a few points, and neither does your insurance premium, which compresses your EBITDA down to that 12 million. Debt service, again, doesn't move. It's fixed at roughly $10 to $11 million a year, regardless of how the top line performs. Subtract the unbudgeted PIP overage and the softer EBITDA from that fixed debt number, and you're left with barely $1 to $2 million of free cash flow. Some years less, depending on when the PIP invoice actually lands. Payback on equity in this scenario stretches past 20 years, assuming the debt doesn't force a sale before you get there. Two scenarios, same building, same brand, same city, and the difference between them isn't the hotel. It's the PIP estimate you trusted, the occupancy assumption you built the debt schedule around, and whether you were buying in year 1 of a cycle or year 6 of one. The building doesn't know which scenario it's in, only the balance sheet does. And notice what actually separated the good outcome from the bad one across both scenarios. It was never the room rate. Nobody's fortune here rose or fell because of the thread count or the size of the lobby chandelier. It rose or fell on a franchise inspector's clipboard, a debt schedule sized against an occupancy assumption, and whether the ground under the building belonged to you or to somebody collecting rent on a 99-year lease. That's not a hospitality business decision. That's a spreadsheet decision wearing a bathrobe. Run the numbers again with slightly worse debt terms, a full point higher on your interest rate, which is not a dramatic assumption in any given financing cycle, and the optimistic scenario's 6% cash-on-cash return compresses to somewhere closer to 4, while the pessimistic scenario's already thin 1.5% slides towards 0. That's the part that should actually keep a first-time luxury hotel buyer up at night. This isn't a business where a bad year erodes your return at the margins. It's a business where a bad year, stacked on top of leverage size for a good one, can erase the return entirely and take a chunk of your principal with it. And that's the part worth sitting with. For $84 million of your own money, in the good case, you clear a return that a diversified stock portfolio would have matched with a phone call and 0 property improvement plans. And in the bad case, you'd have been better off, dollar for dollar, buying an S&P 500 index fund and letting someone else worry about the mattresses.